Hello everybody. So I am starting to do this video about my subscriber stocks. These are stocks that you've asked in the comment section, and I'm gonna do them free by free, and I don't guarantee that I'll cover them all, but I'll cover a few. So today I want to cover Honest, Olaplex, and Symbotic, and I've inputted the number in my spreadsheet here. So first of all, whoever told you to look into Honest, that's interesting because it's a diapers business. It's a diapers play. I mean, we're getting into some real specifics here. This is a very specific business. I'm not sure I know enough about birth rates and the trend in the United States and the diaper business in general. I think this is a kind of stock where you would want to be an industry insider. I mean, I've never have never been close to a diaper. I don't really know. I don't really know anything about those. So sorry about that. But revenue growth, predicted 6% next 12 months. That's not very good. That's not enough to get me excited. Now the stock is cheap, trading at 1x sales, but the gross margin is not good either at 29%. I would think diapers would be much more profitable than that. And so I don't know if these are discount diapers or if they're selling them cheap or what they're trying to do. And likely, I've put these for all of these free because all of these free at interesting revenue growth. This one seems to have had cyclicality, right? Honest, let me bring it to front here. Honest seems to have had cyclicality, and this is all of the prior quarters revenue growth. It seems to have had like a full year of down and then going back up. So I don't really know if they had some sort of a 2020, 2021 spike in sales and then going back up slowly. They seem to be back up, but I don't understand the spottiness of this revenue. I much prefer to see revenue like Symbotic, like the revenue of Symbotic, which I'll get to at the end of the video. That's pristine. That's growing really fast. This has been spotty. It's growing again. The question is, 6% is definitely not enough to get me excited, and they're still losing money at minus 11% on adjusted EBITDA. So the stock is not that. It is slightly expensive, 0.68 on EV over GP over revenue growth, but they're losing money. And they're not growing very fast, and the gross margin is not very good. So good luck. There must be something about the diaper business that I don't know that is special, and so obviously I wouldn't be the right channel for you to inquire about Honest. Now let me move on to Olaplex, and this one, is highly specific, and a hair repair treatment and a hair perfector. And I get a vibe for a company like Olaplex, like a similar to a HIMS, but a HIMS that doesn't specialize in a broad offering. A HIMS that only specializes in something very, very tiny, a tiny segment of the business. It's obviously not that tiny because the revenue is almost $500 million. So it's not tiny, but as far as the segment goes in beauty, you're only focusing on hair. So I know very little about quote unquote broken hair and what makes hair healthy and unhealthy. So unfortunately, I can't analyze the value of the product. What I can tell you is that the rating seems pretty good. 123,000 reviews on Amazon of 4.6. It seems to be a pretty good rating. Same on Ulta, 4.6 seems to be a pretty good rating. Now, from what I understand, and their sales are dropping, and they've been dropping because of, from what I understand, customer complaints on one of their product, and customers saying that the reputation of the brand, has taken a hit because one of their products was not performing as well as they had thought. I didn't dig too much into it because this is not a field that I know much about and I'm passionate about. But obviously, this is a turnaround play. They need to get the growth back to where it was, and that is why the stock is cheap. But because it has negative revenue growth predicted over the next 12 months, I can't even compute an EV over GP over revenue growth. It would be obviously really bad because it's negative, right? So it's worse than not growing. But they are profitable. On the flip side, they're profitable at 35% EBITDA margin. Actually, if you look at their P ratio, it's a cheap company. So turnaround play. I don't know what's going on with the product, but they gotta do something about it to get women to buy the product again. And somehow there's been a downplay in the revenue, right? It's not just reputation. The revenue has been down. Why? I don't know. You'd have to be an insider in this space. And lastly, and this is perhaps the one that interests me the most out of all these free companies my subscribers recommended, is Symbotic. So Symbotic is a stock that I've known about for a while. So what they do is they work for Target, Walmart, and Albertsons, and they are having contracts with these big, I mean, especially the elephant in the room, which is Walmart, like a major contract with Walmart. Walmart actually owns a little bit of Symbotic, and they're developing these warehouse systems in conjunction with Walmart. And of course, when you have a customer like this, that explains this stellar growth in revenue at 61% next 12 months predicted revenue growth. So that is stellar, and serving Walmart and helping Walmart automate. Walmart still has more than 2 million employees. I mean, 2 million employees in the era of automation, in the era of the internet, that seems like there's a lot of efficiency gains that need to be made, and Symbotic appears to be a leader for whoever is competing against Amazon, right? In the case of Target, Walmart, Albertsons. And so the question is, do you want to invest in the company that's not consumer facing, right? The company that's a supplier, that's A, and then B, the supplier to the competitor to the main player in the field. It's kind of like the same question in the electric vehicle business. A company I've covered before. I can't remember the name of that company right now. I don't know why. Anyways, it provides semiconductors to companies competing against Tesla. So do you really want to be helping? Do you really want to be the company who enables the number 2 players? And in my view, there is no doubt that in the case of Symbotic, they enable the number 2 player. And so, Amazon is the number 1 player, and they have Kiva systems and the Kiva robot. And so this is an interesting play. Very high institutional ownership, it seems, for Symbotic. And this stock, of course, when I look at my spreadsheets, it's very expensive at a 1.7. That's very expensive to me. I mean, trading at 20 times sales. So I wouldn't be interested, mostly because of valuation of a stock, but otherwise it seems to be a very pristine asset. I mean, it seems to be an interesting company. They seem to be doing well. So this was a quick one. No investment advice, no financial advice, just entertainment. Please like, please subscribe. Thank you for watching, and have a wonderful day.